Hey there, it is Corey here, founder and financial advisor at Verse. I hope you are going well, and for all of our clients in Melbourne, hopefully you are surviving lockdown. These restrictions are a little tougher than we have seen in the past, and I, like you, am hoping they're over pretty soon. We do have a treat in store for you today. We've got David McMillan, one of the directors and property specialists at Performance Property, here to give us an update on the property market and what is happening in these unusual conditions in this highly unusual marketplace. David will introduce himself in a moment, but he is here to talk about what's happening in the Melbourne market with these current lockdowns in place, what's happening in the broader Australian property market, where he sees the market headed over the next couple of years, what impact the stimulus and government support is having on the market, where he's buying for investors at the moment, and what are the things that he thinks property investors need to be really cautious of in the current marketplace as well. So we'll dive into that in just a moment. But before we do, David, thanks for joining us. I know you're in some isolation yourself at the moment, but maybe tell us a bit about yourself and Performance Property before we dive into the content.
Sure. So thanks for having me on, first of all. You might hear some birds in the background, but I've got no choice because it's screaming kids inside or birds in the background. I've been in property for 20 years, valuer, real estate agent, buyer's agent, researcher. Performance Property I founded 8 years ago, and we essentially help investors make good decisions when building a portfolio.
Well said. Well said. And we know that you guys have been a great support to many of our clients over a long period of time as well. So thanks for joining us. Let's dive in to our content. So first things first, can you tell us what's happening in the marketplace, in particular the Melbourne market at the moment? We're seeing a lot of scary headlines, but hopefully you can help us cut through that and tell us what's happening on the ground.
Yeah, okay. So I think the most important thing that's happening in Melbourne at the moment is there's no is probably the wrong word, very limited A-grade stock. And so what we're seeing at the moment is probably the opposite to what you're feeling if you're watching the news. We're seeing the market hold up pretty well, and in some cases start to rise. And that might sound very strange to a lot of people because obviously the unemployment rate's going up, the underemployment rate is going up. And if you weren't on the inside, it does look, it would appear that I'm giving you the wrong information, but the right information is there's very limited stock of quality property. The market's holding up very well. And in some cases, the market is rising. And that's not just in the A-grade suburbs of Melbourne. It's a bit more broader than that. Even out as far as Melton and the sort of house and land package areas, the market's functioning pretty well.
So when you talk about the market holding up pretty well, I read in the AFR the other day that last quarter Melbourne prices had eased off about 3%. So you're seeing, that's 3% across the Melbourne marketplace. You're seeing some areas of the market where we're actually seeing some price growth, and some other areas that aren't holding up quite as well, but largely pretty solid.
I think it depends on, these median prices, whether they're changing month on month or quarter on quarter, depends on how they calculate how big the sample size is, how many low end sales or how many high end sales. What we're actually seeing on the ground is prices not going down, and if anything, prices rising. And
what impact do you think the government support in place at the moment? Like, we've got a lot of people on JobKeeper, and we've had that in place since March. We've had banks offering repayment holidays, initially 6 months for a lot of borrowers out there. That's been extended by all of the major banks as well. What support do you think that's putting in place for property prices at the moment? And if that's removed further down the track, do you have any, thoughts as to what impact that might have?
Well, I think if it wasn't introduced, more people would have lost their jobs, and more people wouldn't have been able to pay their mortgages, and then there would have been a whole bunch of stock pushed out to the marketplace very quickly, and it would have had a huge negative effect on the property market. That hasn't happened. So the mortgage repayment holidays and the JobKeeper stimulus and other stimulus packages have been everything for the property market. But the question is now whether it's gone too far the other way, and whether it's causing the market to rise unusually in the face of extremely pessimistic employment forecasts. Right. So we're not seeing income growth. We're seeing incomes probably go down, but at this stage, we're seeing prices start to go up.
It's a really interesting dynamic, isn't it? You've got the poorest economic conditions we've had really in history, and there's never been more uncertainty globally, but property prices have held up really well, off relatively high levels as well. And we probably haven't seen and you can speak to it better than I can, but the distressed buyers that we might have anticipated at the start of the pandemic, given the support and the retention of a lot of employment based on that support. So those properties that might have been on the market quickly and being distressed sales, they're not there. And we've got this limited supply.
I think in the first sort of 3 or 4 weeks, in the first 3 or 4 weeks, there was a little bit of that going on.
Yeah.
There was some agents panicking. There was some vendors out there going, "Hey, we need to sell." And then as time went on and the stimulus packages were announced, and then the banks made their positions, very clear, the net result was everyone started to say, okay, well, look, the world's not going to end. This pandemic will come to an end. And when it does, what are we going to be left with? Will we have a job? Yes or no? And for those that know they've got a job now and at the other side of the pandemic, what they're looking at is low interest rates and no stock. And they're finding that they're missing out. And I should throw a stone at that bird. They're finding that they're missing out week on week, and that's causing the market to rise slightly. Now, the big question for the market is what happens to the market when stock volumes get back to their historical norms? You can see the auction levels are about 70% reduced on what they usually are. So once they go back up to sort of 700, 800,000 auctions per week, what does that do to the market? And that's kind of the big questions in our minds at the moment. What's happening right now is the market's robust and arguably rising, but that's what's happening on low volumes. When we revert back to normal volumes, the big question is how will the market behave in Melbourne?
Yeah, are we going to see all this pent-up demand that's been suppressed for a long period of time, or do we see the inverse? The longer the lockdowns take place and the more uncertainty people have potentially, do we see demand not pick up in the way that we might anticipate? It'll be interesting to see.
I might share some slides with you if I can, just to sort of highlight what we've been talking about. So the first one is, can you see that now?
Yep, we've got that, Dave.
Yep. Okay, so this is stock on market. So you can see pretty much in every capital city, year on year, stock on market change has actually gone down outside of Melbourne and Sydney. Okay, so Melbourne has had an increase in stock and Sydney also has an increase in stock, but we're not actually, that's what it tells us in these numbers, but we're not feeling that on the ground through our buyer agents or talking to our seller agents that are in our network. They're simply, they're saying that property's moving really well, and we know through our buyer agent business that we're actually missing out quite a lot, right? So despite there's been some rises in stock, we're not feeling that in Sydney, Melbourne. We're feeling that the market's holding up or going up, as I mentioned, but you can clearly see in the other capital cities that the other capital cities, and these are the cities where we're primarily focused for investors, stock is actually coming off the market by comparison to this time last year. Demand is building. And that's, in our opinion, that's really just because of this low interest rate environment that we're in at the moment.
Very, very interesting. So if we were to separate Melbourne from the rest of, I guess, the country, given we've got a different set of restrictions here, are we seeing any significant differences in how other capital cities are behaving relative to Melbourne?
Well, all markets have the same problem when we're talking about quality real estate right now, and that's no stock. And that's not just the capital cities, that's also the key regional towns. Very difficult to get your hands on any stock. And we're talking to all our guys around the country on Monday last week, and everyone said the same thing. Can't buy anything, property selling really fast. And that's largely because in financial crises, what we've found historically is people don't want to sell because they don't want to sell for a bad price. And so if they can hold on, they will hold on. And then that's caused this current stock shortage that we have now. And plus there's zero for sales going on, none. We can't see any evidence of that happening in the marketplace. That's because the banks are obviously offering these loan repayment holidays, which have been pretty massive for the stability of the market. There is a key downside happening at the moment though, and that's on the rental side. So what we're seeing primarily in Melbourne and Sydney is the vacancy rate rise. This is the year-on-year change in vacancy rates in all the capital cities. But I did a talk probably 3 or 4 about 3 months ago now, saying that we went into this crisis undersupplied from a property point of view, and that's a real positive for the stability of the market moving forward. And you can see the vacancy rate, in fact, over the last 12 months nationally has come down from 2.3 to 2.1, which is a real positive, because it's underpinned the stability of both the rental market and the housing market in combination with other things. But there are some negatives here, and that is Melbourne and Sydney. You can see the vacancy rate in Melbourne and Sydney has jumped, and the Melbourne vacancy rate has jumped the most. And that is people obviously putting Airbnbs back onto the normal rental market because they're not getting the holiday traffic that they usually get. But also because Melbourne and Sydney get the lion's share of overseas migration, which is currently at zero. You're not getting these rental properties fill up as fast as they normally would. So that's the concern here, and we're seeing that in Melbourne and Sydney really result in reducing rents, not massively, but certainly renters have the upper hand. You know, you're a landlord and you're in one of these two cities, you really want to get someone in quick, and if you have to take a $50 per week reduction, you take it, right? So that trend will most likely continue as long as our borders are shut. On the other side, though, we're seeing construction activity slow down. So in 24 months, rather than discussing a high vacancy rate in Melbourne and Sydney, we might be discussing a low vacancy rate in Melbourne and Sydney because nothing's been put out to be completed, right? So it's a very challenging and interesting time for us as researchers and investors. But with Melbourne specifically, the concern right now is not falling prices; it's actually falling rents for investors.
It's really interesting. And, talking about being on the ground, I live in Albert Park near the Melbourne CBD, and the family and I are out for a walk or two each day. And my wife, Christian, and I have commented numerous times that we've never seen so many for lease signs in the area. Normally they're very, very scarce. And there would be 5 times as many for lease signs in the local area than I have seen at any point in the past as well. So, I guess the data is reinforcing what I'm seeing even in my local community there.
We expect the Melbourne vacancy rate to get up to 4 or 5% in the next 12, 24 months before it then goes aggressively the other way. So it looks like there's going to be really soft rentals for the next 12 months at least.
So, I mean, this is probably a good segue into, I guess, asking you about where you're actually buying for investors. So you guys take a really borderless approach to investing. You might have a Melbourne-based client. Doesn't mean you're buying a Melbourne-based asset. So, what marketplaces do you see as being attractive at the moment? Where are you buying and why?
Yeah, so there's 3 things a market needs for it to rise in prices or for it to show value, and that's the market needs to have demand exceeding supply, which is the challenge for Melbourne and Sydney at the moment, especially if stock volumes get back to normal levels. So you need demand exceeding supply, you need the market to be affordable, and lastly, you need the market to have confidence. And as you can see here, when you look at these vacancy rates, you see Brisbane, the vacancy rates come down, meaning that rents are going up slightly. Adelaide, the same can be said there. Adelaide's got the lowest vacancy rate in the country, but the big mover is Perth. Vacancy rate of 3% down to 1.3. But if you went back 24 months, the vacancy rate in Perth was 6%. Right? So rents were softening, and Perth's actually gone the other way now. So when we have a look at the markets that we're recommending, we recommend clients, when they're investing, just follow some really basic principles. The first one is to go to markets when they show value, buy quality property, and then diversify across the states for land tax and just prudent investing to be tied to different economies. But we are buying in some suburbs of Brisbane that are in the value stage. We're buying in some suburbs in Adelaide that are in the value stage of the market, and some suburbs of Perth, as well as suburbs of Bendigo. And how you interpret this clock is if you're lucky enough to buy at the bottom historically, prices will go on a run, and that run will be anywhere from 6 to 9 years long, and the growth may be anywhere from 50 to 100% in total once it gets to the end of its run. And so they're the markets that we're focusing on, the markets that show value. It is possible that we will see price rises in both Melbourne and Sydney in the short to medium term. It is also possible that we see prices come off in Melbourne. It really depends on how long these economic restrictions are placed on us here. But one thing that we do know, and I want to talk about this because it is quite powerful. One of the most powerful indicators in the market is the Affordability Index. So this is the This is the percentage of the average wage that goes to the average new mortgage. And as you can see, in 1980, 26% of the average wage went to the average new mortgage repayment. This is a principal and interest loan with a 20% deposit. The red line there is the year-on-year price change when the affordability index was low or when the affordability index was high. What you can clearly see is when the affordability index gets up to about 55%, in every case, the Melbourne market falls in price, right? You can see the market go negative here in 1989, 1990. When we got to 55% in the GFC, the market came off. When we got to 54% in 2011, the market came off. And most recently, when we got up to 52% in 2018, the market came off. So the Melbourne market doesn't grow past an affordability index of 55. We know that's the price ceiling, and this factors in interest rates, incomes, and obviously house prices. But right now, through these interest rate cuts, what you're seeing is extremely, you're basically seeing extreme affordability. And perhaps to explain it a different way, it's more affordable to service a mortgage in Melbourne now than in any time over the last sort of 15 years. And I know that's very difficult for a lot of people to comprehend, because they're like, well, house prices in Melbourne are 10 times income and they're so expensive and I can't get in. Well, yes, that is true. And yes, it is hard to save a deposit, but right now it's actually extremely easy to service a mortgage because the interest rate is at, a tick over 2%. So historically, when it's been this low, and the last time it got close to this low was post GFC, and the market went up 20%. And a lot of people forget that. A lot of people forget that the Melbourne market immediately after the GFC went up 20%. And the same conditions were at play. Post GFC, no one wanted to sell their property because they were worried they were going to get a bad price. And post GFC, the RBA cut interest rates to try and stimulate the economy. And those two factors combined caused the market to surge in price. Subsequent to that, the market came off, of course. But I wanted to highlight to people that it's not necessarily a certainty that prices in Melbourne are going to fall in the next 12 months or the next 24 months. It is entirely possible that prices rise. And what we're seeing at the moment is, in fact, that price is rising. But I don't think that it's fair to say that we're off and we're going to definitely rise, because the big challenge for Melbourne is how it actually performs when volumes return to normal. And that's something that we'll see in the next 6, 12, 18 months. But I don't think that the banks are going to do what they did in the 1990s and just push properties out for sale in a for sale situation because someone's defaulted on their mortgage. Their behaviour is completely different to the last recession. Where the last recession, they just pushed properties out for sale. You couldn't pay your mortgage, bad luck, you're gone. And now it's kind of like, oh, okay, well, let's work with you. Let's do everything we can to try and, get out of this situation. And then maybe, we'll give you a holiday for 6 months. And then after that, we might give you another 6 months. And that's never happened before. Yeah.
I mean, on the back of the Royal Commission, the bank's reputation and their brand took a really big hit. And, through the COVID crisis, they have been really supportive to the Australian community and Australian households. They really have, which has been really, really good to see. And it's unlikely that will change. This chart I find really, really interesting, because it is in part a contradiction to a lot of the content you'll read online and through the news about, I guess, almost it's a foregone conclusion that Melbourne prices will fall, say, 10 to 15%. Do you feel like, in terms of the content that, say, your clients out there or our clients might be consuming, is potentially oversimplified? Because there are so many complexities to the Melbourne, the market, and different influences, and there's a level of unpredictability. But when you read, when you're reading the news out there, that's not really the narrative that I'm seeing. It's more that, prices are going to fall, expect them to fall 10 to 15%, before we get from, peak to trough.
Yeah, I mean, look, bad news sells better than good news. And I mean, you just got to call it how you see it, right? We're not trying to sell anything. I mean, we are trying to sell property, I suppose, but we're not necessarily trying to sell property in Melbourne or Sydney. We're just trying to identify how the market functions and how we make good decisions with the data that we're receiving, right? And I think the most important thing for people in Melbourne and Sydney right now, especially if you're an investor, it's probably still not the market to be investing in, because the only thing that's making this market make sense is low interest rates. And of course they could go up and all of a sudden then the market doesn't make sense. So it's not whether you should buy in Melbourne for investment purposes so much, unless you've got a very, very long-term horizon. It's more so, should I be panicking and selling now in Melbourne because of what I'm seeing in the news? And certainly what we're seeing is the opposite to what's being reported in the news. We're not seeing prices soften. We're not seeing prices fall. If anything, the data that's being fed back to us is sort of mounting a stronger and stronger case that the market may actually rise in the next 12 months. And I know it's very controversial, but like, I've got investment properties here in Melbourne, and probably 3 or 4 months ago, I was thinking that I might sell one, but now I'm just thinking that, hey, I think that the market could go on a little bit of a growth run here, similar to what it did after the GFC. Now, you can see after the GFC, it was very short-lived. It went up 20%, and then it started to, come off a little bit. But that's because the affordability index got up to its maximum threshold. The Melbourne market could actually run 30, 40% before it got back into that 50% affordability index.
Yeah, it's interesting. I mean, when the GFC happened, the RBA cash rate from memory was about 7.5%, and they cut rates down to 4.5%. And then we avoided a recession, a technical one anyway, and prices started to rise, and the RBA started to push the cash rate up again relatively quickly. But we're talking about a cash rate now, like an RBA cash rate of 25 basis points, and interest rates on mortgages, P&I, own occupy under 3%. Fixed rates closer to 2% than they are 3%. So I guess what we're seeing that play out in terms of the affordability index you
can see that play out there, where the only thing that made the Melbourne market affordable post GFC was the interest rate cut. Right, prices didn't come off; it was just the interest rate cut, because prices remained static through that 1 year period. And then the thing that made the affordability index much more expensive in the following years, yes, was price rises, but also interest rate rises. And then all of a sudden it became unaffordable again pretty quick. We're at it would be a very optimistic sort of rate forecaster who said that we're going to be raising interest rates in the next 24 months. So if you mount the case that interest rates will be flat for the next 24 months, well, what does that mean for property prices when confidence actually comes back? Because at the moment, we don't have confidence in the market. I think confidence is at an all-time low. So
very, very interesting, Dave. The commentary is valuable. The data is valuable. We're going to wrap up shortly. Before we do, is there anything else that you want to share out there for investors or people in the marketplace?
I think now more than ever, it's really important to have your strategy in place, and obviously that comes with the plan with yourself, Corey. It's not a time for knee-jerk decisions to buy or knee-jerk decisions to sell. I mean, it's never a time for that. But certainly, what we've seen with our client base has been some panic sort of conversations around, I want to sell everything. It's not a time for that. It's really a time to make sure that you're having a conversation with yourself, Corey, and that your strategy is sound. And in times like this, that's why you have a strategy, is so that you're expecting something like this to happen. You've got a risk management strategy around this. For us and our clients, it's really around the long-term planning process and also the cash flow management process. And so that right now enables you to sleep at night, essentially.
Yeah, really well said. I mean, being an advisor myself, difficult times, primarily as the advisor, you're reinforcing the principles that you were laying out pre-difficult times. And you're reinforcing the goals and the priorities, and the goals and the priorities and the strategy and the principles and the fundamentals, they don't deviate because we move into difficult times. We know that difficult times pass as well. So, I think just, having someone like yourself, Dave, if you are investing in property in your corner, you become that thing that gets in the way of them and maybe making a rash or a poor decision. And it's those, as it's those mistakes that over the long term, particularly when you're talking high value transactions like property, the things that cost people financial freedom and security and wealth further down the track. It doesn't take many mistakes. So
Absolutely.
Yeah, absolutely. I think we're on the same page. I am going to have us wrap up there, Dave.
Perfect.
We appreciate the rundown from you and that bird that you had in the background there for a
Yeah.
while. Sounds like a crow, I think, but very insightful. The data is valuable to see. Hopefully, our clients out there are understanding more of the complexities at play across the marketplace at the moment. And you know, David's helped you cut through some of the commentary and some of the news that you might be consuming at this point in time. You know, and it's good to see that we've got relatively stable prices and a relatively stable marketplace in a really unstable time. So thank you, Dave. I'm sure we'll have you on again soon enough to give our clients another property market update. If people want to be in touch with you, our clients, many of them already are, you can always reach out to us for an introduction. And for those, Dave, that might be watching this video that aren't clients averse, or aren't yet clients averse, hopefully, how can they get in touch with you and the team at Performance Property?
Look, just jump on the website, Performance Property. It's all very straightforward from there. So I
Lovely.
appreciate the plug, mate. Thank you.
Good to see you, Dave. Take care and
Thank you.
look after yourself and the family.
You too, mate. Thank you.
Bye.
Bye.